Hey everyone, welcome back to the channel. Subscribe for more crypto learning videos and trading guides every week. Don't forget to hit the notification bell to stay updated with the latest crypto insights. If you're new here, this is the place where we break down crypto trading, investing strategies, and how to make smart moves in the market. Today we're diving into a topic that confuses many beginners: spot trading versus futures trading in crypto. By the end of this video, you'll have a clear understanding of both, and you'll know which one might suit your trading style best. Let's get started and make sure you avoid those costly beginner mistakes. Start with spot trading. This is the most straightforward way to trade crypto. When you buy or sell cryptocurrencies on the spot market, you're dealing with the actual coins at their current market price. For example, if you buy one Bitcoin at $60,000, you now own that Bitcoin and can hold it in your wallet. If the price rises to $70,000, you can sell and pocket the profit. Spot trading is simple, transparent, and ideal for those just starting out in crypto. Let's make this even clearer with an example. Imagine you purchase one Bitcoin at $60,000. You now own that Bitcoin and can store it in your digital wallet. If the price climbs to $70,000, you can sell it and make a $10,000 profit. This is the essence of spot trading. You buy low, sell high, and the coins are yours until you decide to sell. It's a straightforward process that many beginners find comfortable. Spot trading comes with several advantages. First, you actually own the crypto you buy, which means you can hold it for as long as you want. It's also much simpler and safer for beginners since there's no risk of liquidation or margin calls. Plus, it's ideal for long-term investors or those who believe in the future of crypto and want a hodl. If you're looking for a low-stress way to get started, spot trading is a great choice. Of course, spot trading isn't perfect. The main downside is that your potential returns are lower compared to more advanced trading methods since you can't use leverage. It can also take longer to see significant profits, especially in a slow market. And if prices fall, you can't make money on the way down. So while it's safer, it's also a bit slower and less flexible for active traders. Now let's talk about futures trading. This is a more advanced and riskier way to trade crypto. Instead of buying the actual coins, you're trading contracts that predict the price movement of cryptocurrencies. Futures allow you to use leverage, which means you can control a larger position with a smaller amount of money. This can lead to bigger profits, but also much bigger losses if the market moves against you. Here's how futures trading works in practice. Suppose you trade Bitcoin futures with 10x leverage. That means a $100 trade acts like $1,000. If the price moves in your favor, your profits are multiplied. But if the market goes the other way, your losses are also multiplied, and you could even lose your entire account. Futures trading can be exciting, but it's definitely not for the faint of heart. Futures trading offers some big advantages for experienced traders. You can profit whether prices go up or down since you're betting on price movements. Leverage lets you make larger trades with less capital, which can lead to higher returns. It's a favorite for short-term traders who want to take advantage of market volatility. But remember, these benefits come with significant risks. Downsides of futures trading are serious. There's a high risk of liquidation, meaning you can lose your entire investment if the market moves against you. Futures require strong technical analysis skills and strict risk management. They're not suitable for beginners, and trading with high leverage can quickly wipe out your account. If you're new to crypto, it's best to avoid futures until you have more experience. Let's compare spot and futures trading side by side. First up is ownership. With spot trading, you actually own the crypto you buy. You can transfer it to your wallet, hold it, or use it as you wish. With futures trading, you never own the actual coins. Instead, you're trading contracts that represent a bet on the price movement. This is a key difference that affects how you manage your assets. Another big difference is risk level. Spot trading is generally low to medium risk since you're only exposed to the price movement of the coins you own. Futures trading, on the other hand, is high risk because of leverage and the possibility of liquidation. It's important to understand your own risk tolerance before choosing which type of trading to pursue. Leverage is a major factor that separates spot and futures trading. In spot trading, there's no leverage. You can only trade with the money you have. In futures trading, you can use leverage, sometimes up to 100x, to control much larger positions. While this can amplify profits, it also increases the risk of losing more than you invested. Always use leverage with caution. Who should use spot trading and who should use futures? Spot trading is ideal for long-term holders and beginners who want to build wealth slowly and safely. Futures trading is better suited for experienced traders who understand technical analysis and can manage risk effectively. Knowing your own experience level will help you choose the right path. Liquidation risk is another key difference. In spot trading, there's no risk of liquidation. Your coins are yours until you decide to sell. In futures trading, if the market moves against your position, your trade can be liquidated and you could lose your entire investment. This makes risk management absolutely critical in futures trading. Profit direction is also different. In spot trading, you only make money when the price of your coins goes up. In futures trading, you can profit whether prices rise or fall since you're betting on price movements. This flexibility is attractive to active traders, but it also adds complexity and risk. Think of spot trading like buying gold and holding it in your safe. You own the asset and its value changes over time. You can sell it whenever you want, but you only profit if the price goes up. This analogy helps many beginners understand the simplicity and security of spot trading. Futures trading, on the other hand, is like betting on whether the price of gold will go up or down. You don't own the gold itself, you're just speculating on its price. This can lead to quick profits but also quick losses if your prediction is wrong. It's a more complex and risky way to trade. So, which trading style is right for you? If you're a beginner, it's best to start with spot trading. This allows you to learn how the market works without taking on too much risk. As you gain experience and confidence, you can explore futures trading with small amounts and low leverage. The key is to build your skills gradually. Spot trading helps you understand how crypto markets move. You'll learn to read charts, spot trends, and make informed decisions. This foundational knowledge is essential before you try more advanced strategies like futures trading. Take your time and focus on learning the basics first. Once you're comfortable with spot trading, you might consider trying futures, but only do this after you've learned how to read charts, use stop losses, and manage risk. Start with small amounts and low leverage to minimize your exposure. Remember, futures trading is not a shortcut to easy profits, it requires skill and discipline. No matter which trading style you choose, risk management is crucial. Always use stop-loss orders to limit your losses if the market moves against you. A stop-loss is an automatic order that sells your position at a certain price, protecting your capital. This simple tool can save you from big losses and help you trade with confidence. If you're new to futures trading, never use more than 3-5x leverage while you're learning. High leverage can lead to huge losses very quickly. By keeping your leverage low, you give yourself more room to learn and avoid catastrophic mistakes. Remember, slow and steady wins the race in trading. One of the biggest mistakes new traders make is trading based on emotions. Fear and greed can lead to impulsive decisions and big losses. Always follow your trading plan and stick to your strategy no matter what the market is doing. Discipline is the key to long-term success. Before risking real money, practice trading on demo accounts. Many exchanges offer demo or paper trading where you can test your strategies without any financial risk. This is a great way to build confidence and learn how the market works before you put your hard-earned money on the line. For long-term investors, spot trading combined with dollar-cost averaging (DCA) is a powerful strategy. DCA means investing a fixed amount at regular intervals regardless of the price. This helps reduce the impact of market volatility and builds your portfolio over time. It's a simple, effective way to grow your crypto holdings. To sum up, spot trading is safer, slower, and perfect for beginners. You own real crypto, there's no leverage, and you can take your time learning how the market works. If you're just starting out, this is the best place to begin your crypto journey. Futures trading offers the potential for faster profits, but it comes with much higher risk. It's best suited for experienced traders who understand technical analysis and risk management. If you're new to crypto, take your time before jumping into futures. No matter which trading style you choose, always start small and focus on learning the basics. Don't risk money you can't afford to lose. The crypto market can be unpredictable, so patience and education are your best tools for long-term success. Confidence in trading comes from experience and knowledge. Take time to study the market, practice your strategies, and learn from your mistakes. Over time, you'll develop the skills needed to trade successfully, whether you stick with spot trading or move on to futures. Many beginners make costly mistakes by jumping into futures trading without proper preparation. Avoid this by starting with spot trading, practicing risk management, and only moving to futures when you're truly ready. Remember, slow and steady wins the race in crypto. The crypto market is always changing and there's always something new to learn. Stay curious, keep up with the latest trends, and never stop improving your trading skills. The more you learn, the better your results will be over time. Every successful trader has a plan. Decide in advance how much you're willing to risk, what your goals are, and how you'll react to different market conditions. Sticking to your plan helps you avoid emotional decisions and stay on track for long-term success. Technical analysis is a key skill for both spot and futures traders. Learn how to read charts, identify trends, and use indicators to make informed decisions. This knowledge will help you spot opportunities and avoid common pitfalls in the market. Patience is one of the most important traits for any trader. The market won't always move in your favor and it can take time to see results. Stay patient, stick to your plan, and don't let short-term setbacks shake your confidence. Keep a trading journal to track your progress. Record your trades, what worked, what didn't, and how you felt during each trade. This helps you learn from your experiences and improve your strategy over time. Stay informed about the latest news and developments in the crypto world. Markets can move quickly based on news, regulations, or new technologies. Being up to date helps you make better trading decisions and avoid surprises. Consider joining trading communities or forums to learn from others and share your experiences. Connecting with other traders can provide valuable insights, support, and motivation as you navigate the crypto market. Crypto trading is a journey of continuous learning. Markets evolve, new strategies emerge, and technology changes. Stay open to new ideas and keep building your knowledge to stay ahead of the curve. Be cautious of scams and promises of guaranteed profits. Only use reputable exchanges and never share your private keys or personal information. Protecting your assets is just as important as making profits. Every trade involves balancing risk and reward. Don't chase quick profits at the expense of your long-term goals. Focus on steady growth and protecting your capital, and you'll be more likely to succeed in the long run. Set realistic expectations for your trading journey. Profits won't come overnight, and losses are a normal part of the process. Stay focused on learning and improving, and don't get discouraged by setbacks. Regularly review and update your trading strategy. Markets change, and what worked yesterday might not work tomorrow. Stay flexible and be willing to adapt your approach as needed. Celebrate your small wins along the way. Every successful trade, every lesson learned, and every milestone reached is a step forward. Recognizing your progress keeps you motivated and focused on your goals. To wrap up, spot trading is the best starting point for beginners. It's safer, simpler, and helps you build a solid foundation. Futures trading offers more potential for profit but comes with higher risks and requires more experience. Start small, keep learning, and always manage your risk. That's the key to long-term success in crypto trading. Thanks for watching. I hope you found this guide helpful as you start your crypto trading journey. Remember, the most important thing is to keep learning and never risk more than you can afford to lose. Stay tuned for more beginner-friendly crypto guides, and I'll see you in the next video.